In this video, we are going to explain national income by income method. How to measure national income by income method. According to income method, national income is estimated by adding incomes earned by all the factors of production for their factor services during a year. We are aware that the contribution made by producing enterprises to the current flow of goods and services in the economy is termed as net value added at factor cost, NVFC. To make this contribution, enterprises use factor services of the factors of production, such as land, labor, capital, and enterprise. It means net value added is the result of the combined efforts of these factors of production. Therefore, it is but natural that net value added is shared among these factors of production. The share which the particular factor receives becomes its income. In this way, net value added becomes factor income when it reaches the hands of factors of production. Therefore, net value added and factor income are one and the same thing. When we look at it from enterprises side, it is value added, and when we look at it from factor owner side, it becomes factor income. When a particular enterprise contributes to the production process through value addition, it also generates income simultaneously. It means each rupee of goods produced either by an enterprise is matched by a rupee of income generation. Hence, we estimate GDP either by value added method or by income method, both resulting into the same results. So, according to income method, domestic factor income or NDPFC is the sum total of payments received by all the factors of production for their factor services in the domestic territory of a country during a year. So, we see that according to income method, all the incomes that accrue to the factors of production by way of wages, profits, rent, interest, etc. are summed up to obtain the national income. Let us find out what are the steps of income method. First, identifying the producer enterprises which employ factors of production. This is the first step. All the producer enterprises are divided into three main sectors. These are primary sector, secondary sector, and tertiary sector. These sectors are again divided into subsectors. Second step, classification of factor incomes. Factor incomes or factor payments are generally classified into compensation to employees or compensation of employees. It is also known as income from work, operating surplus, and mixed income. What is compensation of employees? Compensation of employees refers to amount paid to employees by employer for rendering productive services. So it includes all payments and benefits which the employee received directly or indirectly from the employer. Compensation of employees consists of three elements. Number one, wages and salaries in cash. We'll find it wages and salaries in kind, and employers' contribution to social security schemes. Third step, estimating domestic income. When factor incomes of all the sectors are summed up, we get domestic income, that is called NDPFC. So NDPFC is equal to compensation of employees plus operating surplus plus mixed income. Finally, estimating national income. If we add NFIA to NDPFC, then we'll get national income or NNPFC. Components of domestic factor incomes. Compensation of employees includes wages and salaries in cash, wages and salaries in kind, and employers' contribution to social security schemes. Now let us know what the wages and salaries in cash. Wages and salaries in cash refers to all monetary payments which employees receive in respect of their work from employer. It is the largest component of compensation of employees, and this includes basic pay, dearness allowance, cost of travel to and from work, bonus, sick leave allowance, commission to sales staff, gratuities, etc. Wages and salaries in kind. This is also called compensation in kind. It refers to all kinds of non-monetary advantages and facilities given by the employers to their employees. For example, accommodation either rent-free or at a nominal rent, free ration or subsidized food, uniforms, imputed interest on loan or free loans, interest free loans, free traveling arrangements, recreation and holidays facilities, creches for children of employees, free provision of goods and services produced by the employees, departmental facilities in the campus of enterprises, value of free medical facilities, and so on. These are the non-monetary benefits received by the employees from the employers, and this needs to be included to calculate compensation of employees. Employers' contribution to social security schemes. It includes employers' share towards employees' insurance, life insurance, retirement pension, provident fund, etc. So these are to be included. Next, operating surplus. Operating surplus is defined as the excess of gross value added by the producer enterprises over the sum of domestic compensation to employees, net indirect taxes, and consumption of fixed capital. See this one, operating surplus is gross value added minus compensation to employees minus net indirect taxes minus CFC, consumption of fixed capital. Operating surplus are two parts: income from property, which includes rent, royalty, and interest, And the other part is income from entrepreneurship, which is profit. Profit is equal to dividends plus undistributed profits plus corporate taxes. Sum of these three is the profit, or it is also called the corporate profit. Undistributed profit, sometimes it is known as savings of corporate sector or retained earnings, plowing back of profits. So operating, another formula, operating surplus is equal to gross value added minus compensation to employees minus net indirect taxes minus CFC. This relates the value added method and the income method. So operating surplus, we can say operating surplus is equal to rent plus royalty plus interest plus dividend plus undistributed profit plus corporate taxes. Mixed income. It is the income generated by own account workers like farmers, barbers, etc., and unincorporated enterprises like retail traders, small shopkeepers, and those who are included in profession, doctors, lawyers, chartered accountants, etc. So it is known as self-employed income. A self-employed person provides his labor as well as his property in his work. It becomes very difficult to segregate wage income and non-wage income from his total earnings. Thus, his total earning are mixture of income from work and the income from property and entrepreneurship. So how to calculate national income? First, under this method, we have to find out NDPFC. And NDPFC is equal to, compensation of employees plus operating surplus plus mixed income. Now, compensation of employees is equal to wages and salaries in cash, wages and salaries in kind, and employers' contribution to social security schemes. Up to this is the income from work. Then we find operating surplus, rent plus royalty plus interest plus profit, and profit is equal to dividends, undistributed profit, and corporate taxes. And income from own account workers plus profits and dividends of unincorporated enterprises. These two are the elements of mixed income. These three are the elements of profit. And 1, 2, rent, royalty, interest, dividend, undistributed profits, and corporate tax is the element of operating surplus. First three is the element of compensation of employees. Next, 1, 2, 3, 4, 5, 6 is the element of operating surplus. And under this, the last three are the element of profit, corporate profit. And last two, that is income of own account workers plus profit and dividends of unincorporated enterprises, are the elements of mixed income. So thus we'll get the NDPFC. Once we get the NDPFC, it is easy to calculate national income. National income is equal to NDPFC plus NFI, net factor income from abroad. Let us know the precautions of income method. Transfer payments, incomes like taxes, gifts, donation, old age pension, unemployment allowance, scholarships to the students, etc., should not be included in factor income because they are received without rendering any productive services. These are unilateral transfer. These are the transfer payments, and transfer payments are not included in the estimation of national income because there is no value addition for such transaction in the economy. Value of imputed rent of owner occupied houses should be included because if the same house given rent on elsewhere, it could have earned certain amount of rent. So it is a factor income. It should be included. Incomes earned through illegal activities like smuggling, tax evasion, etc. should not be included. Windfall gains like income from lottery income should not be included because there is no current flow of goods and services for such transaction. Income from sale of second-hand goods will not be included. Second-hand goods will not be included because these are originally included. Income from sale of shares, bond, debentures will not be included because these are the mere transfer of papers. There is no corresponding production of goods and services in the economy. Payments made out of past savings like death duties, gift tax, wealth tax, etc. are not included in national income because these are payments are made from the past saving. These are not the current year expenditure. Indirect taxes are not included in national income, that is NNP FC, but included in NNP MP. So these are the precautions we need to remember while calculating national income by income method. That's all for today. Thank you.